Hello, my name is Tian. In our group, we will talk about the One.Tel company. The first one, I want to talk about the One.Tel background. This company was established in 1995. That's major in the telecommunication operation. Both Gender Rich and Brandon Killing created this company. They also received a reinforcement by a few influence persons in Australia, like Parker and Murdoch. Prior to its total decline in 2001, it was the first largest telecommunication city in Australia. The main model of the marketing had a close nexus with the personal communication. The success of One.Tel Limited are heavily attributed to the IPO strategy that was tailored between 1995 and 1997. This was through a business plan that the Gender Rich have developed for the company in September 1994. The plan connected the company to Optus, which was ranked second among another telecommunication company in Australia. The problem that the field collapse of this organization began in the year 2000. The report loss added up to $291 million. The success of this company included Centuries and the car phone warehouse. Century took over the One.Tel business that were based in UK in 2001. Century successfully ran the company until 19 December 2005, when it sold them to the car phone warehouse. Upon the takeover, car phone warehouse merged its sales groups with TalkTalk. It is essential to highlight that the failure of the company was largely blamed on the Gender Rich. A case against the Rich lasted for the 2072 hearing date. Nevertheless, Justice Austin ruled in favor of the defendants.
Hello, I'm Yu Shen. I'm talking about the accounting failure of One.Tel company. The reason of the bankrupt of the One.Tel company include weak internal control systems, low quality financial reporting and audits reports, poor supervision of board on management, and a poor communication between the board and management. Internal control system is one reason for accounting failure. It was which led to accounting failure. According to the information provided by Australian Securities Regulatory Commission, one of Mark Silverman, One.Tel CEO Judy Rich, and Financial Director Mark Silverman rarely watch company's separate sheets, monthly reports to the board, the debitor and creditor report, billing reports, and on-cash checklist. The manager of One.Tel company pay less attention on the account financial information. One.Tel company does not have a real-time debt and credit risk characterization system. In short, this indicates that One.Tel company's internal control system is weak due to it does not have organizational structure, accounting systems, process audits, and other necessary controls. Accuracy and integrity of financial records apparently do not get preferential treatment of senior management.
When the standards of good governance are applied to One.Tel, it is clear that the practices of One.Tel management did not comply with good governance. In this section, I will look at three aspects of One.Tel. Financial reporting quality. Financial reporting quality is high when financial reports accurately represent the position of the company. It is clear that the financial reports were not truly represented in the annual report. We can find, as revealed in court cases between ASIC and Mr. Rich, that there are discrepancies in several records and documents, including monthly trial balances, collection of accounts receivables, data descriptions, and an outstanding balance of accounts receivable. And this meant that One.Tel did not have a real-time or close to real-time information about total debtors, aging, and risk profile of debtors. And so that raises the question of how management really made their decisions. Board composition and activity. Analysis of 1998 annual report suggests One.Tel had 4 members in the board that year. One of the joint CEOs had excessive influence on the board. This was because all board members were subject to election each year except Jody Rich, one of the joint CEOs. This ensured that he always remained as a chief executive officer. This raises concerns about the power of Mr. Rich in the company. He had a big influence in the decision of the company, and this is further supported by the fact that 4 out of 10 meetings were chaired by Mr. Rich himself, not by the chairperson. There is also evidence that lack of full disclosure may have indirectly contributed to the non-executive director's ability to monitor management, and so raises a failure of corporate governance.
Further evidence that One.Tel purchased a lot of non-audit services from its external auditor. The non-audit fees as a proportion of the total fees paid to the auditor were 41% in 1996 to 1997, 55% in 1997 to 1998, 52% in 1998 to 1995, and 46% in 1999 to 2000. If being engaged in NAS with a client firm provides useful insight into an evaluation of a client's internal control, the planning of audits, and the prosecution of it, it's unclear whether the audit's quality in One.Tel improved at all as a result of the NAS. Overall, in our group presentation, we think the manager in One.Tel company should pay more attention on the accounting financial information, and they have to improve their accounting systems. As earlier mentioned, there are many corporate governance failures that are raised. Financial reports were not properly viewed by decision makers, and much of the information was not presented in a real true manager. In terms of the board, one of the joint CEOs and excessive influence of the board.
The auditory jobs in the world of the institution of the chartered accountants, chief the executive Stephen Harry is to make all necessary inquiries, open them to ensure that the financial activities of the company have been accurately recorded. The evidence presented in our discussions suggests that the One.Tel reported and did not faithfully represented its fundamental earning process. Low audit quality folks concealed One.Tel real financial board and shareholders.
It is clear that the downfall of One.Tel cannot be attributed to any one party. The lack of company structure, professional ethics, and corporate governance are to blame. The One.Tel case and succeeding corporate collapses send a message. This message is that directors and management must play an active role in the running of the company. People must be held accountable for their actions and decisions. Accurate reporting of cash positions is a must, and internal controls should be monitored and assessed continually to account for changes and growth in an organization. And auditors need to ensure that they are able to scrutinize the company's financial reports and provide an independent view that ensures the company's reports reflect a true and faithful position of the company.